Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market update, options skew extremes, hedge fund rankings, and equity breakouts. This video presents a direct informational narration of the source document. All right, let's start by looking at the daily market close. The S&P 500 closed higher, showing some solid breadth with 354 advancing components compared to just 148 decliners. In fact, 10 out of the 11 major sectors posted gains today. Healthcare and utilities really led the charge, with the communications sector being the sole outlier that actually fell. It's also worth noting we saw some late-day put option hedging, likely as participants brace for potential weekend volatility.
Here is the roadmap for today's explainer. We'll start with the macro and geopolitical headlines, then look at the latest drop in consumer sentiment. After that, we'll unpack the current extremes in options market skew, review the latest hedge fund strategy rankings, and wrap things up with some technical updates on individual equities.
Section 1. Macro and Geopolitical Headlines. To set the stage, Kevin Warsh has officially been sworn in as the 17th Federal Reserve Chair. Meanwhile, over in the commodities market, oil prices have rebounded slightly amid a wave of conflicting geopolitical reports coming out of the Middle East. So what exactly are we hearing on the geopolitical front? It's a complex picture with several competing narratives right now. On one hand, there are reports of Pakistani and Qatari officials in Iran trying to finalize an agreement, and Sky News Arabia even suggested a framework consensus was reached in Tehran. However, Iran's foreign ministry directly countered that, stating that deep-rooted differences with the U.S. definitely remain. On top of that, a source close to Trump indicated his growing frustration, mentioning the potential for a final, large-scale military operation. Now, a scenario like that carries a very real risk of escalating inflation right before the midterm elections.
Moving on to Section 2, Consumer Sentiment Data Drops. The data from the May University of Michigan Consumer Sentiment Index is in, and it showed significant underperformance pretty much across the board.
Let's break down these exact numbers because they paint a very clear downward trend. The overall index dropped to 44.8, which missed the expectation of 48.2. The Market Conditions Index also fell, coming in at 45.8 against a 47.9 expectation and down from the previous 47.8. Crucially, inflation expectations are ticking up. The one-year expectation rose from 4.5% to 4.8%, and the five-year rose from 3.4% to 3.9%. And to put this into perspective for the everyday consumer, a striking 57% reported that high prices are actively eroding their personal finances.
Section 3. Options market skew extremes. We are seeing massive demand for call options right now from both institutional and retail players, pushing positioning to near record highs in what looks like an extreme FOMO-driven rally.
To really grasp what's happening here, we need to understand volatility skew inversion. It's a rare condition that occurs when the implied volatility, or IV, of call options actually prices higher than that of equivalent put options. When we see this inversion, it serves as a clear, data-driven indicator that the market is aggressively chasing upside.
The metrics we're tracking right now are highly unusual. Look at the S&P 500 put skew. It has absolutely plummeted to roughly 0.04. For context, that is the fourth lowest level we've seen in 20 years. What this tells us is that downside put protection is incredibly cheap at the moment, simply because market participants are overwhelmingly prioritizing buying calls.
Let's look at how this skew inversion breaks down by index. Currently, 20% to 25% of S&P 100 components are inverted, compared to a historical norm of just 3%. In the NASDAQ 100, we're seeing 25% to 35% inversion against a normal level of under 10%. But the real standout is the semiconductor index. A massive 35% to 50% of its 30 components are currently inverted. That metric perfectly matches the extreme upside chasing we saw back in 2021.
Now for Section 4, Hedge Fund Strategy Rankings. Many funds have managed to recover the losses they took at the onset of the Iran conflict, but overall, year-to-date performance is still trailing historical averages. Let's run through the absolute performance rankings of 12 distinct hedge fund strategies based on the latest data. Taking the top spot at number 1 is Systematic Macro CTA, followed by Systematic Diversified CTA at 2 and Equity Long/Short at 3. Rounding out the top half, we have Relative Value Convertible Arbitrage at 4, Macro CTA at 5, and Global Strategy sitting at 6.
Moving down the list, equal weight strategy is 7th, event-driven M&A is 8th, and event-driven specialized is 9th. Finally, relative value strategy comes in at 10th, absolute return at 11th, and equity neutral brings up the rear at number 12.
Now, it's really important to put these returns into the proper context. Massive funds, think a $10 billion portfolio, operate very differently than a smaller retail account. They prioritize strict drawdown constraints, like capping their maximum losses at 25% over chasing pure yield. Their risk appetite and overall strategy are completely different from a smaller $10,000 portfolio that is just aiming for absolute returns.
On to Section 5, Sector Index Breakout Action. Market breadth looked notably strong today, with 10 of the 11 sectors rallying broadly.
Diving into the price action of the major ETFs, the semiconductor indices, specifically the SOX and the SMH, showed real strength. They successfully held their earlier lows, broke upward, and squeezed into fresh historical highs with zero technical pressure overhead. At the same time, the software index, the IGV, also hit recent closing highs, which appears to be driven by steady, stealthy institutional accumulation.
Finally, Section 6, Individual Equity Technical Updates. Let's look at the technicals and fundamentals of a few key names based on recent market action. Starting with AMD, the stock posted a new closing high after successfully defending that 400 to 420 support zone. Fundamentally, this is being driven by strong CPU demand, tight capacity, and their capacity-building partnership with TSMC. When we look at forward price-to-earnings valuations, models are projecting a 2027 upper boundary of 439, assuming a 30 to 40 times multiple.
As for NVIDIA, it has successfully worked off its previous overbought status. The equity continues to find solid structural support on both the weekly and monthly timeframes, and there's a critical boundary of support clearly located just below that 211 price level.
Looking at TSMC, it's trending steadily toward higher highs supported by strong technicals. Google, on the other hand, is a slightly different story. It's facing expected volatility and shrinking volume on down days. This specific action is directly tied to the company's major equity investment in the highly anticipated upcoming SpaceX IPO.
Wrapping up our equity updates, TRV is continuing its slow, sideways movement while holding at elevated levels. Meanwhile, ISRG's price action is focused very tightly within a technical range, strictly between 321 and 405.
To close out today's explainer, we're left with a major question. Given the extreme option skew inversion we just looked at, which shows a complete absence of downside protection being bought right now, how exactly is the market going to process and react when the next wave of macro inflation data hits and tests these current dynamics?